Welcome to ETM Analytics and TreasuryONE's weekly market review. It is a short week. It is Easter, and I'm joined this week by Cilliers, the currency strategist, at TreasuryONE. Andre, how are you?
I'm very well in this short March. Normally a short April, but this year a short March.
Let's start with last week's big news maker. It was, of course, the Fed's decision to keep rates unchanged, kind of what we've been expecting. But what is noteworthy is that the Fed now officially penciled in 3 rate cuts throughout 2024 of about 0.25% each. And with this dot plot, the Fed's signaling and the market's expectations are finally aligned.
Yes, at last. I don't think that the Fed was ever on 7 cuts. It was only the market that reached that, I want to call it, ridiculous level. They always get ahead
it was
of
a bit
themselves.
Excessive. Yeah.
They always get ahead of themselves. I mean, markets love speculation. It's what drives the markets. It's what happens. And we've been living it for the last 30 or 40 years, and we will live with it for the next 40 years. But at least it's now aligned. With a few humps and bumps that could still come up as we go along, but at least in agreement with Mr. Powell from the Fed chair, that says, watch the figures, wait for inflation to turn solidly, wait for inflation to get closer to the target levels before we actually cut. So that longer period of interest rates at higher levels, rhetoric, speech of his is at least now coming to the forefront, and the market agrees with him.
What do you think are some of the bumps that they will be looking out for that could possibly change?
Okay, so if one looks at the next graph and the US financial conditions, that's still really relatively loose, and one just really needs to look at the equity markets. If you see the buoyant equity markets, you know that there's still a lot of cash floating around, and that amidst some of the sectors in the American economy that is getting headwinds, like the housing, like car sales, etc. These things are getting the wind from the front. So apart from that and the impact of that it could have on companies and economic growth and their financial results, we still see money flowing into the equity markets. And that underlines these financial conditions that's relatively loose. That could, together with elevated oil prices, continued tension in the Middle East and the war in the Ukraine and Russia, and now on the heels of that comes that attack by ISIS in Russia, for which Russia now says, it was launched from inside Ukraine, could escalate things, and that could bring about a bit of pressure on inflation. And as we go forward, that little hiccup in inflation or stubbornness of inflation could most probably extend the period where we see cuts by a month or 2. I still think it's on the cards. I don't think it's negating anything, but the longer for interest rates higher session could still be on the cards for another month or 3.
Yeah, I think that is the narrative that's going to stick around for a while. But let's hop on over to China quickly, where the currency came under severe pressure. It fell to its 4-month lows last week, and it comes on the back of expectations that there might be some monetary loosening as the state seeks ways to start boosting the Chinese economy. They're getting there, but the economy the wheels aren't oiled all that well yet, I think, for the Chinese state. But reportedly, some of the reports came out this morning that the depreciation was in fact sufficient for state-owned banks to start stepping in and trying to protect the currency as it continued with some depreciation against the US dollar.
Yes, one must remember that the tentacles of the Bank of China extends a little bit further than just the Bank of China, because they're state-owned banks. So there's that little phone call that goes through and says, guys, you'd better start doing something.
Like now.
This is why I say, those tentacles extend a little bit further. But if you look at the Chinese economy, they are having headwinds. And I've now said for a very long period of time that if you look at what happened in China, where their massive growth came from for many, many years, that led to trouble into their construction sector, severe problems in their construction sector. And now you sit with a Chinese government and a Chinese central bank that people want them to stimulate the economy. But you can stimulate as much as you want to. If you don't have the domestic demand, then it becomes problematic. Then you need the outside world, you need the world economy to return to solid, proper growth so that they can have an export-led growth within their economy and not only from a domestic consumer side. So internationally, markets are not doing well. Growth is not there, and that puts the Chinese in a bit of a tickle because their domestic side is not coming to the forefront. The market knows this, and we've now earlier mentioned about how markets get ahead of themselves. They want to see ASAP, as soon as possible, a change in monetary policy, a package by the government to get that economy back onto tracks to higher levels of growth. And in the meantime, they're basically attacking the currency. And we've seen what happens in our markets on the rand when people attack a currency. If they want it weaker, they take it weaker. Until such time as they satisfied with the levels, or until such time as they satisfied with what packages or stimulus is being pushed into the market by a central bank and by government. So for the moment, I think the Chinese one will remain under pressure. But one must not forget that if the Chinese market is under pressure, they're part of the emerging market package. And that places other emerging markets slightly under pressure as well. And we're one of them.
Yeah, and speaking of which, domestically this week, obviously the spotlight will be on the MPC meeting this week. Expectations, rates will be kept on hold, but we will be looking at the forward guidance, of course. And when you look at the market expectations, we've also gone down, and market's now expecting only one rate cut for 2024. Obviously, a lot of that influenced by also the amount of rate cuts expected by the Fed as well. So that was kind of influenced. But all in all, not too much to expect from this week's announcement.
Yeah, we just have to look at our inflation figures picking up again, and then we know that don't expect anything from a central bank this week by lowering interest rates. As to the guidance that they will be taking, let's just for a moment go back to Frau Lagarde there in the European zone, where she continuously mentions, that they will look at what other people do, and other people is obviously the Fed. Will do exactly the same. But inflation is also an interesting one, and I've read last week in an article that somebody said, if you look at America, there is a point where inflation breeds inflation. Because companies are battling with higher interest rates, higher finance costs, etc., and for them to get that little bit of money back that they have to spend on that, they increase their prices. So it becomes a bit of a cycle, and I'm wondering whether we're not basically in that cycle in South Africa already. If I look at price increases, if I look at company results, if I look at how consumers are under severe pressure, and not being able to turn to banks that much anymore for credit because they've used everything that they can get, and the banks are battling with defaults on home loans and their write-offs on that and their provision for bad debt. So yes, we're also in for some cuts, but longer, higher rates is the narrative, not just here, not just in America, all over the world. So no interest, no surprises by the government. And some years back, during an election of the National Party, in one of their constituencies, Mr. Piet Koorenoff in the Primrose constituency had a bit of a battle and stood to lose his seat in Parliament. And the central bank then came out and lowered interest rates. And that pulled him through. The people were very happy in the country, and they voted again for the National Party and also in Primrose. So no Primrose cut to be expected by the central bank because we're heading into elections. They'll stay where they are.
Yeah, no, I think Lesetja Kganyago will hold the line on that one. He's been very steadfast against any political mingling, if we can put it that way. But Andre, before we wrap up, it is a shorter week for the rand. What can we expect?
Okay, expect some profit taking towards the end of the week, depending on what happens around the globe. But the rand is a very, very happy chappy in the 1820, 1920 range. And it's been sitting in that range for quite some time now. And if you look at the euro, very happy in the 108, 109 range for quite some time. So I don't expect anything major to happen during the course of the week that will upset this broader range of the rand of 1820, 1920. So when we speak again next week, I think we'll still be here. Very happy.
Andre, thank you very much. Have a blessed Easter, and we will catch up again next week.
And the same to all the viewers. Thank you very much, IlzeMari.